Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's just after 1:30 on November 5th. I got a busy week, and now we are joined by Adam Collins of Movement Capital. Adam joins us each week to talk about market seasonality and the latest CoT report, breaking down all the information that very useful. Adam manages many different websites. He has a lot of great information. He has freecotdata.com, movementcapital.com, simplestockmodels.com, and commodityseasonality.com. So a lot of great websites, a lot of great information. He's going to go over a number of those when we're talking. But Adam, I'll let you take it from there.
Yeah, happy to be here. And right off the bat, nothing I talk about is investment advice. I don't treat it as such. And for any new listeners, the main thing I talk about is the CoT report. And the CoT report outlines how traders are positioned in the futures markets. So this is an example CoT report right here that shows a snapshot of, you got different categories like producers, users, money managers. You got long shorts. If you net it together, you get net positioning, but it's important to know the context of that net positioning, if it's high or low relative to the past 5 years, not just, a weekly glance. So let's get into it. This is sort of the main page on the website I use. It's a dashboard, and how it works is you've got all these different, categories. Like you got speculators, hedgers, producers and users, and then dealers and financial futures. And then this graph basically shows by individual contract the net positioning in that contract. And so if you're over here at like 100%, these are all 5-year percentiles. If you've got a 5-year percentile of 100%, it means that that trader category is more net long than they've ever been over the past 5 years. So for example, right now, traders are quite long Henry Hub nat gas futures. On
long
the flip
and happy.
Side, yeah. And so on the flip side, we've got, soft commodities, some precious metals, and OJ. And so I sort of define extreme positioning as a percentile either greater than 90% or less than 10%. And then we can sort of zoom down to because this is all commodities up here. Now we've got financial futures. And the main takeaway is that speculators are still very short dollar. But the thing that's changed about that is that a number of these charts are starting to, put crowded spec shorts under pressure. And so, so when it comes to spec positioning, I mentioned nat gas, and we can zoom in on a different chart. So this is sort of some other custom stuff I run, and this is looking at spec positioning in dollars. So we can see that traders are net long probably $1 billion or so of nat gas futures, which doesn't sound like a lot, but relative to the past 8-9 years, it's a lot. And then we got some other stuff that sticks out, like OJ. Strangely enough, for all two of you that trade OJ, traders haven't been this net short OJ ever in the history of this data set. And that is truly extreme positioning. And we can zoom in on, let's take some of the precious metals. Actually, we can look at crude real quick. So with crude, here's one way to slice it. You've got the dollar value of net spec positioning, and as you would expect, it is quickly racing down. So we hit highs in positioning of probably like 55 billion earlier this year. Now we're at a hair above 30 billion. And then we've got that statistic as a percentage of open interest, not just dollars. And it's also coming down. And then we've got gold over here. So there's been definitely some short covering in gold. Not a massive amount, but definitely some. We've got, on the flip side of that, as specs have covered, hedgers have grown more net short as they've been more willing to sort of hedge future production at these, marginally higher prices. Then we've got copper. So copper, earlier this year, traders were very bullish going into 2018 long copper. It sort of fit within the whole global growth narrative. And as that fell apart, spec positioning in copper futures fell apart. And we're definitely low relative to the past 2 years, but relative to the past, 5-10 years, sort of the middle of the range. So I wouldn't read too much into that. But going back to the website, I think the main story with positioning right now is probably FX positioning, in that people are very short yen, Aussie dollar, New Zealand dollar. That in and of itself is not new news, but what is new is that the charts are starting to be tougher to deal with, if you're a short. It's not, a massive, 5-10% move, but be it Aussie dollar, Kiwi dollar, the recent price action is definitely putting spec shorts under pressure. And what I always talk about with COT is it's not enough if position is extreme. You have to have extreme positioning plus price action that's giving people sort of incentive to flip on that extreme positioning. And that's happening right now in those currencies. A little less so in the yen. The yen's still ticking lower. We definitely saw last week, not just positioning too, it was more so Brexit stuff, but the pound caught a bid. And then let's go back to the dashboard page. Let's see, we can look at hedger positioning commodities. So for example, right now, producers and users haven't been this net long WTI, OJ, cocoa, soybeans in a long time. And so what this means is that when you're looking at sort of hedgers and they're sort of extremely net long relative to the past, what that means is that producers haven't been apt to hedge a lot of their future production, but users who hedge by buying have been, heavily sort of hedging their future use needs by buying futures. On the flip side of that, there are no commodity contracts with sort of extreme producer hedging activity, which means that, I don't know, there's not a lot of contracts where producers are happy to lock in prices right now. And then we can zoom in on some individual positioning charts. Let's take a look at nat gas because that sort of stuck out. Let's see. All right, so here we are. So the white line is the spec positioning in nat gas. And you can see how we're definitely high right now. And the last times that was the case were in October 2016 and Jan 2017, and both times were not good times to put on fresh long exposure. We can dive into some of the precious metals. So, a couple weeks ago, platinum, silver, and gold were all very sort of crowded short trades, and that is no longer the case. Positioning in platinum futures, especially on the spec side, is definitely moderated. RBOB, I talked about that like 2-3 weeks ago, and where spec positioning was basically at a 5-year net high, and that has obviously not worked out for RBOB longs. Let's look at a price chart of RBOB or any of the energies. It's not just RBOB. Yeah, and so what period was that? Let's see. That was the week of like early October, and so early October is right about here. And so if you would have, at that point in time, seen how crowded net long COT spec positioning was, that might have, disincentivized you from taking RBOB long exposure or even gone short, which would have obviously worked out quite well. And then we can turn to some of the FX stuff I mentioned. So we got Kiwi dollar down here. Position is as short as it's ever been, but price action starting to flip on them. Swiss franc positioning, specs are leaning short, not extremely so. Then we got Aussie dollar up here, where it's not as extreme as in Kiwi dollar, but I think it's worth paying attention to. And we can zoom in on some of the FX charts. Let's see. All right. So we got Aussie dollar here. Specs are short, like net short, like 50% of the open interest. Pound, a little less so. CAD is honestly mixed. Nothing to write home about in CAD positioning. Your positioning is still one of the few, foreign currencies where traders are still quite net long. We got yen, pretty crowded on the short side. Peso, which is a pretty illiquid contract, so I wouldn't read into it too much, but I thought this was interesting that specs were so net long peso relative to, EM being under pressure. We got Kiwi dollar, which is the one that stands out the most, 100%. Then we can turn to equity positioning. Let's see. All right, so as you expect, traders have pulled long exposure in the Dow, in the NASDAQ, and in the most important contract, the ES. But ES positioning hasn't come back a massive amount. Here's the dollar. Yeah, here's the dollar amount. So, early January, traders super net long, like 120 billion in ES futures. They've cut that more than in half. So they're net long like 55 billion right now, which is muted relative to 2018, but relative to the past decade, there's definitely a lot of dollars, still long ES. Then we've got Japanese stocks over here. So Japanese stocks were quite a crowded long trade a couple weeks or months ago, and it's definitely fallen back and now positions like middle of the range. This is a pretty interesting chart right here. So this is taking S&P, NASDAQ, and the Dow, just netting it all together. and it's the same message as the ES chart, that traders are still quite net long. We can look at VIX positioning. And so traders have predictably grown a lot less net short VIX futures as they've had the spike. And then sort of as the nominal value of VIX futures has gone up as it spiked, the total dollar value of VIX positioning for the open interest has definitely rocketed up. We've got the net, this is a pretty important graph. We've got net spec positioning in VIX futures, a dollar amount. And so at their most bearish, they were net short like 1.5 billion. Now they're basically flat. And so if somebody says, hey, everybody's still short VIX, that is not the case. That positioning sort of washed out. That's the number of contracts. Now we can go to seasonality. And so just as I mainly look at the dashboard page for COT, I mainly look at the dashboard page for seasonality. So this is November seasonality. This is the average monthly performance by contract over the past 20 years. So stuff on the left has worked well in November, stuff on the right has not. So the highest performing contracts in November have historically been OJ, Palladium, the S&P, soybeans. Worst performing energies, which is obviously panning out this month. I sort of think it's interesting. I know it's not super relevant because like nobody trades OJ, but I showed that chart of OJ positioning right here. Okay, so traders haven't been this net short OJ ever, and then also OJ's historically one of its best months of the year has been November. And anecdotally, I've personally found COT to be slightly more effective in some of the more less liquid contracts as opposed to the stuff that everybody watches, like WTI and gold. And so so November seasonality summary, sort of a motley crew on the higher performing, but energies and grains, weaker. So this is looking at the term structure of the degree of contango or backwardation between the front month and second month contracts. So in Henry Hub, definitely flipped a bit into backwardation, meaning that the second month price is trading lower than the front month price. So if you're long, you aren't bleeding anything. In fact, you're capturing sort of like a roll yield. So if that's the contract with the highest amount of backwardation, the highest amount of contango is found in corn. And then we've got momentum. And so this is just 12-month roll-adjusted price momentum for all these commodity futures. Stuff on the left has gone up. Stuff on the right has gone down. This is sort of a metric for like long-term CTA, sentiment, because they're sort of trend biased. And so the best performing commodity contract over the past 12 months has been wheat. The worst performing has been lumber. And then we can dive into some individual energy contracts. So let's look at what was one of the negative seasonality. In fact, let's just look at energies. So I've talked about it before, but it's still quite relevant. Q4, very weak for heating oil, nat gas, less so, but especially so in WTI. November's been the worst month of the year in WTI over the past 20 years. And that's for front month futures. Turning to the last website, this is basically how I discern my longer term bias in the S&P. So this is not intraday at all. This is more so like a holding period in weeks or months. And I split up the website based on like technical, sentiment, rates, and macro. So here's some stuff on S&P technicals. 12-month momentum is still positive. Trend, if it's measured by distance to a 200-day moving average, has actually just dipped negative. That's the first time in more than 2 years. We got seasonality. Seasonality is actually quite strong for the S&P in Q4. FOMC drifts, so we've got FOMC meeting later this week, and so historically the S&P has exhibited this tendency to rise more often than not, pre-FOMC. So we're definitely in that period right now. We are outside of the buyback blackout period, as most of these companies have reported earnings, and so in 2018 buybacks are a massive thing, and that was probably a contributing factor to last week's rip. And then margin debt. So people show these charts about margin debt, these huge figures like, there's $650 billion worth of margin debt out there. I think it's important to look at the rate of change as opposed to the absolute level. And margin debt is actually decelerating. So margin debt has only grown by like 6.9% year over year, which is definitely slower than 2017's pace. Turning to sentiment, all the sentiment surveys are sort of panning out of what you'd think of. People are getting more pessimistic, but not extremely so. So this is like the This is the AAI survey. It's sort of like a retail centric survey. And so people are responding more bearishly, but we're not at like the early 2016, super bearish extremes. The one thing that was interesting about sentiment was, so this is the CBOE's total put call ratio, and it's definitely up there. So this is definitely indicating some sort of consensus pessimism from option traders. And then the VIX futures curve is definitely in backwardation, and it's been there for probably 2-3 weeks now, which is a pretty long clip. Over the past couple of years, we've sort of flipped into backwardation, flipped out. Turning to rates, the Treasury yield curve, as measured by the 10s and 2s, it's flattened by 40 bips over the past year. High yield spreads are actually trading above their 12-month moving average. So this is meaning that spreads are blowing out a little bit. Not extremely so, but I definitely think that's worth watching. Macro indicators. So U.S. macro data is still quite healthy. Industrial production, retail sales, and housing prices have all risen over the past year. But last week's ISM PMI print was a little lower than previous. So we sort of topped out at 61. Now it's 57.7. So any PMI greater than 50 sort of indicates continued growth. And so we're definitely still there. It's just sort of slowing down. But overall, that is about it when it comes to positioning seasonality in the S&P. So if anybody's got any questions, I'm happy to help out.
Yeah, thanks a lot, Adam. A lot of great information. Had a few questions here. You were alluding to it when you were talking about FX, the old FX world. Aussie and Kiwi got very stretched, and it was actually last Wednesday we had a big move. We had about a 2% move higher in both Aussie and Kiwi. And it's funny, I brought up the chart right now. Kiwi got down to about 64.30 in mid-October, and now here we are at 66.50, and we're at levels. This was levels that we saw back in early July, so a huge amount of the move was wiped out despite the huge short positioning. Do you think the market is as short as it was before, or you think the Wednesday that it will readjust in the next positioning report?
I think definitely like the last half of last week probably saw some short covering, but even then, it's a thing of when you're starting from such a low level. There's a lot of money embedded on the short side, and I don't think a 1 day 2% move wiped out the majority of that.
Yeah, it's for the whole dollar index as a whole has grinded up the entire month of almost September and October. 10 basis points, 10 basis points, 10 basis points, and last Wednesday was a big chunk of that taken back. That's interesting to keep an eye on with that one. Question for you: emerging markets, emerging market equities. Is there anything that your studies, whether it be any of your websites, track to show how the market is positioned in that? Because emerging market equity, like EEM as a whole, has underperformed, and emerging markets have underperformed this year. And I was just wondering, is there anything that you track that can show positioning for emerging markets?
Yeah. So coincidentally enough, this is the chart. And so if you tell me where the USD is 6 months from now, I'll tell you the relative performance between international and domestic stocks. And so it's a thing of where, as the USD has ripped, international has suffered, and it's sort of a combination of stretched short FX position against the USD, a USD chart that probably doesn't look super pretty to any sort of like technical analyst. That gives me more confidence in a long EM or long international relative to US. And in fact, I think there was one day last week where EM popped like 3.5 or so. And so, yeah.
It was on that Wednesday. It was that same Wednesday where the dollar weakened.
Yeah. And so to me, I don't directly track any international economic indicators or anything, but it's a USD story. And if the USD keeps ripping, there's little hope for the international stock bulls. But if the rally is exhausted, then maybe there's something there.
Yeah, well, it's interesting. What you said is correct, especially in the short term. The EM and the dollar have that sort of inverse relationship. But if you take a look at the 10-year performance of emerging market equities, it's roughly flat. And the S&P is up significantly. And the dollar, probably over a 10-year period, is ballpark flattish. Like it's not anything to. I mean, S&P has gone up dramatically in that 10-year period, and EEM hasn't done a whole lot. And so, while shorter term, the dollar is a very big player in it, there are definitely other components to it. And I was just wondering in general, because EEM has underperformed for a good year now, steadily, probably almost 2 years.
Yes. Yeah. So if you're talking about something like, 10-year returns in EM, you got to ask yourself, where do we start? Where were we 10 years ago in EM? So one word, overvaluation. That was sort of like the back end of the BRICS phenomena. And so all fund managers want to say, hey, we've got big exposure in the growth engine of the world. And it's one thing to be the first person to that idea, but when you're the last person and you pay super high valuations, if you pay a high price, you're going to lock in a lower than average future return. And that's changed now, and that EM valuations are cheaper. But I will say this: valuations are this really tricky subject where who is to say what is cheap or what's not? And if somebody tweets out something like, the CAPE ratio for EM is 13 and for the US is 31, that does not mean that doesn't necessarily say what the correct EM valuation level is. So, for example, I don't think you can compare those two numbers like for like, because when you're valuing the cash flow stream of like a company in Brazil, there comes with that a lot more risk that you have to discount for relative to a company like Apple that doesn't have big concerns over like
Yeah,
political risk.
absolutely.
So EM's definitely cheap. But that has, I mean, people have been saying EM is cheap since 2011. And so it's just a thing that I think if you're the type of investor that's making like really long-term strategic allocations, maybe an EM overweight makes sense in that context. But I mean, valuations got zero bearing on day to day.
No, yeah, and once again, I'm not even talking about cheap or expensive or anything of that. I'm just simply wondering, the initial question was really, is there any sort of CoT or seasonality
Oh,
or any sort of indicator from even simple stock models, anything that really shows how the market is positioned in the individual instrument?
no. So there actually are there's some MSCI futures for both EFA and emerging markets. I don't track them. I should. The reason I don't track them is because they're quite thinly traded, and I think there's not a lot of data going back on them. But in regards of the simple stock model website, here's what's relevant for EM. So I've actually run some numbers on this. So what this page does, this macro page, is it looks at these economic indicators and says, hey, historically, when has it worked to sort of pull equity exposure relative to the readings of these indicators? And a lot of people might think, okay, this is all very US centric, right? Industrial production, retail sales. What's interesting about it is that these indicators are not equally as effective, but quite effective for gauging international exposure. And I'll say this with the caveat of I'm not trying to avoid 10% corrections with these indicators. I'm trying to avoid the big sort of recessionary drawdowns. And what I'm getting at is if you sort of assess sort of the health of the global economy by some of these indicators, the macro picture still isn't super ugly. In fact, it's still quite constructive in that you've got, businesses are spending money, consumers are spending money. I don't know. And I think that trickles down to, while we're not we're not the crazy optimistic, global growth is synchronized of narrative of like January 2018. I'm not so quick to get bearish on the global economy, just given how some of this macro stuff is indicating.
Sure, and that ties into Thursday's Fed. I think that they're probably going to signal on pace to hike rates again in December, despite everything. The recent few percent sell-off in the S&P and the recent turbulence in. I'm sorry, the recent sell-off in the S&P, and then also President's comments about not wanting to hike rates. I mean, what they look at based on the information, they're probably going to continue to hike.
Yeah, I'll be interested to see how the market reacts in terms. Let's say they come out. Let's say they fully retain hawkishness, and they don't include some phrase like conditions on financial markets bear watching. Basically, if they don't indicate any increased sensitivity to recent volatility, if the market pukes off of that, that says to me, okay, we basically we didn't fully discount a Fed that doesn't care about a 10% correction. But if, let's say that sort of a clause like that is included, I don't know. It's just going to be interesting to me because I personally think the market consensus has changed and has accommodated for a Fed that is wholly different than Bernanke or Yellen. Basically, I think the market has realized that, Powell doesn't care about a 5% drop in ES and basically looks at inflation, looks at employment, et cetera. And I don't know. It'll be interesting to see how the market reacts if their language changes to it.
Yeah, I think that we're getting into the point now where they're important. The message itself will be important to say, and like you said, will they talk about the recent volatility? Will they allude to anything about the global markets? The global markets, European, Asian markets are down. Double digits. Many of them, at least, they were at some point last week. So there's been more turmoil there. But I think these statements are going to be interesting, and I think this is going to be a really interesting week. Today's a bit of a quieter one. It's Nasdaq's been under pressure. S&P's grinding up actually as we speak. We're almost at the high of the day, up 9. Nasdaq down 65. Yields down a touch today, but yeah, I think we're in for a very interesting week with election and then Fed on Thursday and everything else that comes along with it. But Adam, thanks a lot for joining us. A lot of great information as always. Really appreciate it.
Yeah, thanks a ton.
All right, talk to you later.
Bye.